Hello, everybody. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. Isn't it amazing how quickly things can change in the financial world? Case in point is the interest rate environment here in Canada. The Bank of Canada benchmark interest rate was sitting at historic lows at the start of 2022. And just one calendar year later, it shot up to the highest level since the early 2000s. Now, this might seem totally unprecedented for Canadians feeling the pinch of higher borrowing costs, but history shows us interest rates have risen and fallen very quickly many times before. So, what happens next with interest rates? Well, that's anyone's guess. All of this interest rate uncertainty may be frustrating for income investors. For example, the interest they can earn from fixed rate bonds today may be less attractive if rates rise in the future. While there are some investments that aim to ride the interest rate roller coaster, and floating rate income funds are one of the alternatives that investors may consider. We're going to learn all about them from our guest speaker. Joining us is Darren Arrowsmith, Vice President and Fixed Income Portfolio Manager at CI Global Asset Management. Darren, thanks so much for being here with us.
Thanks for having me, Caitlin.
Can you tell us a little bit about what you do in your role at CI and your experience in the fixed income space?
Yeah, so I've been in the financial markets for approximately 25 years. I started my career at Scotiabank on their fixed income team in research and trading. And then I was in London with GE Capital, and that was really where I learned my credit skills and first worked with floating rate assets. And then I came back to Canada through Montreal, working for a small asset manager as a PM, as a portfolio manager, again, mostly in high yield credit. And then I returned to Toronto to CI Investments as a portfolio manager, again, in predominantly high yield credit, managing bonds and loans, hybrids and preferreds, and co-managing the CI floating rate income ETF. So my whole career has been in fixed income, almost entirely in credit, and a majority of it has been managing floating rate assets through multiple interest rate cycles.
Okay, wow. So we definitely have an expert in this space with us today. So definitely excited to pick your brain on these assets. So how have you seen interest in floating rate income funds change as interest rates have risen over the past couple of years?
So it's interesting, Caitlin. Floating rate demand actually tends to take its cue initially from the direction of the US 10-year government bond yield level, not central bank policy rates. So when the 10-year treasury yield or the Canadian 10-year government bond yield is rising for benign reasons, as in when the global economy is expanding or in growth mode, like in 2021 and 2022, demand for floating rate assets tends to be stronger. And that's in fact what we saw, even though the Bank of Canada and the US Federal Reserve raised their overnight policy rates aggressively through last year and have continued through the first half of this year. There was more demand for floating rate funds in 2021 and 2022 than there has been this year, as the 10-year Treasury yield increased dramatically in 2022. But the 10-year Treasury yield is actually relatively flat so far this year.
All right, so we're getting into some of the weeds. So let's step back and get kind of with the basics for our viewers to make sure they're coming along the ride with us. So first off, let's lay some groundwork around bonds in particular. So how do bonds work? Can you explain how they offer income to investors?
Yeah, so bonds typically give you income by paying a fixed coupon rate. Now, this is the interest rate you're periodically paid on the money you've lent by buying the bond, which is called the principal. This fixed coupon rate is usually either broken into two semi-annual payments, or that coupon is paid once annually. And it's set at the time the bond is issued and remains the same until the bond's maturity. That's for a fixed coupon bond. The level or size of the coupon reflects partly the underlying government or benchmark interest rate that corresponds to the term to maturity, plus what's called a spread. And by spread, we mean the rest of the yield over and above the government bond benchmark rate And this extra part of the bond yield reflects the credit risk or default risk specific to that corporate or sovereign issuer. So fixed income assets are typically rated by the three major rating agencies. And the major categories are investment grade and sub-investment grade. Investment grade represents everything from a triple A rating down to a low triple B rating. High yield or sub-investment grade is anything from a high double B or double B plus rating down to triple C or into defaulted investments.
Right. So not all bonds are necessarily created equally. There's the coupon rate, but then there's a lot of other factors that kind of go into the pricing, is what you're saying,
That's right.
essentially.
Yeah.
Yeah. So rising interest rates, obviously what's going on in the past, especially the past year, how can that be problematic for bond investors?
Well, for fixed income bonds, a rise in yield means a fall in price. So rising interest rates can be problematic for investors because they erode the value of the fixed coupon set on the bond. So let's take an example. Let's say a company issued a fixed coupon corporate bond a year ago when rates were generally lower. And then let's say the same company comes to the market or came to the market a week ago to issue another new bond in our current higher interest rate environment. When you think about it, the running fixed coupons on the older bond remain the same, they're fixed. Assuming rates stayed higher for both bonds from there onwards, the older bond is less attractive because its running income stream, its cash flow stream, is farther away from current market rates, right? So to compensate for that erosion, the that erosion in the value of its cash flows over time, the price of the bond decreases and you have an unrealized capital loss. For longer dated bonds with lower coupons, especially pure government bonds that don't have a spread or an element of credit risk as a component of the yield that might be improving or compressing at the same time to help offset a move higher in interest rates as part of that bond's yield, an increase in interest rates can be particularly painful for something like a government bond or a low coupon bond because the impact is that much more apparent and the correction in price can be more extreme.
Right. So if last year's bond is paying 3% and that's the rate forever, and the new bond's paying 4%, we wouldn't pay the same, right? We're not going to pay the same price for one that's paying 3% when we get one today for 4%. So it completely makes sense that that would be, yeah, a huge impact on prices. So as we mentioned earlier, floating rate income funds are one type of investment that aim to address this issue. So how do they work?
So a floating rate fund is comprised of instruments that pay interest at variable or floating rates. So the income you make from the assets changes over time as certain short-term interest rates change. These funds primarily invest in loans whose coupons are typically floating in nature, but they may contain other short-term or other floating rate instruments like short yield to call bonds, floating rate notes, and floating or rate reset preferred shares or hybrids. Most of the assets of a floating rate income fund, whether a bond, loan, or preferred share, bear interest rates that are expressed as a spread over a base rate, like we've talked about. The most prevalent base rate in the US that's used on floating rate instruments now has become the secured overnight funding rate, or SOFR as the acronym goes. And this is the interest rate that banks will be paid in return for lending out their government bonds that they hold within their treasury book for short periods of time into what's called the treasury repurchase market. Now, borrowers or issuers of floating rate instruments that may be found inside a floating rate income fund often have the option to choose what term or rate maturity they want to base their interest payments off of. So the most common ones are either 1 month or 3 month maturities, which means your coupon or income stream resets at the new term rate plus the fixed credit spread every 1 or 3 months. So you can kind of think of the term to maturity of each investment as kind of a continually rolling maturity of 3 months or less, because you're essentially remarking the interest portion of the loan or bond to market every reset period. And here we're assuming all other things equal, obviously, that the spread portion of the yield remains unchanged. So effectively, the portfolio can be very responsive to changes in short-term interest rates. So when short-term rates go up, the SOFR, or the secured overnight funding rate component of a borrower's interest rate, as well as the income to a portfolio invested in floating rate instruments, also goes up, right? It works the other way too, obviously. So when short rates go down, the income to the portfolio might go down as well. What this leads to, though, is greater price stability of the underlying assets, because the value of the floating rate asset doesn't really erode like a fixed coupon bond does from a change in rates, absent a deterioration in credit quality.
Right. So you're kind of riding the ups and downs as interest rates change, as opposed to the price of the bond changing, the actual interest rate is changing instead.
Right, right.
Okay, awesome. It's very interesting option there. So, what are some of the potential benefits of holding floating rate income funds?
Floating rate funds aim to provide an income distribution that keeps pace with benchmark interest rates, like we've talked about. And those benchmark interest rates are highly correlated with central bank rates, and therefore much less sensitive to unfavorable changes in rates, like a rapid increase in interest rates that would lead to a drop in the price of a fixed coupon bond, essentially a paper loss, right? Like we've talked about. This can be particularly helpful when benchmark interest rates are rising, because income goes up with those rate moves. So a floating rate fund can help provide protection against rising interest rates. It can help diversify an investor's income sources, and can help lower a portfolio's correlation to other asset classes, therefore increasing the stability across a broad portfolio.
Okay, so when we consider the benefits, we always have to, of course, take the risks on the other side. So, what are the potential risks of holding floating rate income funds?
Most assets are sub-investment grade, right? So for the CI floating rate income ETF, for example, even though almost 1/3 of the fund is currently rated investment grade or low triple B or higher, the rest is sub-investment grade, so below triple B. Coupled with that, the main risk in a fund, in funds like this, is credit risk, right? So that's essentially the risk of non-payment of interest or principal when due, and that's obviously higher for a fund that comprises corporate credit. This would first be expressed by a decrease in the value of the individual investments in the fund as the market begins to price in this risk. If a borrower defaults, the result would likely be a reduction in income and a decline in market value of the floating rate income fund. The other main risk is, as we've already touched on, would be the risk that short interest rates decline and go the other way than the direction that they're going now, and the amount of income or the yield to the portfolio compresses. And then lastly, floating rate term loans are deemed less liquid than other investments, predominantly because of the settlement time, which is slightly longer than a regular trade date plus 2 days, and this could be discounted into the price of the ETF at times.
And when you talk about kind of the credit rating of these different investments, so you said that like a third is investment grade, and then kind of the rest is sub. So is that to try and get like a better return? Is the idea you take a little bit more risk to hopefully get a little bit more return on these kind of more short-term type investments? Is that the idea behind that?
That's the idea. That's the idea. You want to improve the liquidity profile of the fund. You want to, by having a chunk of investment grade assets in there, and then the sub investment grade gives you extra yield.
Floating rate income funds tend to invest in high yield debt investments. How does this riskiness of these funds compare to other alternative credit products?
The largest asset class within floating rate income funds in our peer group tends to be the floating rate senior term loans. And like we've talked about a little bit, these are first lien senior secured loans that are at the top of the corporate capital structure. And by capital structure, I mean the hierarchy or seniority of a company's stakeholders, from secured lenders down to equity holders. First lien loans are secured on the assets of the company and are higher ranking in corporate insolvency. And so they typically exhibit higher recovery rates than unsecured high yield bonds in an economic downturn. By recovery rate, we mean the extent to which the principal or original loan and accrued interest on defaulted debt can be recovered. This downside protection, mixed with less upside above par, leads to less overall volatility and greater portfolio stability versus other high-yielding asset classes. And compared to other fixed income funds, floating rate funds typically have larger exposure to floating rate loans, whereas a traditional fixed income fund will normally be comprised of government bonds and corporate bonds.
Okay, so you're saying, so the capital structure idea is the idea that if the company were to go into liquidation, bankruptcy, then you would get money before a lot of other investors, including those who hold like common shares and preferred shares and that sort of idea.
That's right. That's right.
Yeah. Even other, like you said, even other credit type products, any other fixed income type products potentially.
Yeah, especially if the bonds are unsecured, of an unsecured nature. So given that you're collateralized by the assets of the company, you you get paid out first in a waterfall.
Makes sense. Kind of like being secured against a mortgage, being secured against a house versus like a credit card debt sort of idea.
Right. That's right.
Yeah. So, what sort of investor might be interested in holding floating rate income funds?
So investors that might consider floating rate income funds are typically income focused investors who want higher yields but may not want to take the heightened risks associated with equities. Investors who want to diversify their income sources and generate relatively high risk adjusted monthly income from asset classes that are a bit less correlated with some of the others, like equities. Investors who are worried about the impacts of inflation and potentially higher interest rates would obviously be interested in these funds as well.
Okay, so lots of different options, lots of different potential people who might be kind of more interested in looking into these types of funds to add them to their portfolio or at least research them a bit further. Now, floating rate income funds can differ greatly in their composition, so comparing their performance as a group can be a little bit tricky. But let's focus on the floating rate loans that are typically found within them. How have they generally performed during past periods of rising, flat, and falling interest rates?
Historically, floating rate loans as an asset class have been shown to outperform other fixed income asset classes during periods of rising interest rates. Annualized returns have been relatively attractive compared to investment grade bonds during flat interest rate periods. And here we've looked at US interest rates since the mid 90s and subdivided it into periods of rising rates, stable rates, and declining rates. And we're showing median annual returns of the Credit Suisse Leveraged Loan Index, the Bloomberg Barclays US Aggregate Index, which includes government bonds and investment grade corporate bonds, and a US Treasury Index. And clearly you can see that floating rate assets obviously outperform in periods where rates are rising, but the asset class performs competitively to other fixed income asset classes during a flat rate environment and competitive with high yield in a declining rate environment. But the volatility of the asset class is much lower. So when you look at it on a risk adjusted basis, the risk adjusted returns are attractive across most rate environments.
Okay, very interesting. So we get some different periods where they're outperforming, and then even when they're underperforming, the value is more consistent. So very, very interesting. There's a lot of uncertainty about the direction of interest rates in 2023. What's your read of the situation and what it might mean for floating rate income funds?
Well, it seems that with core personal consumption expenditure, or core PCE, which is the Federal Reserve's favored inflation measure, staying above target and still relatively high, albeit trending downwards, and with asset prices rising and nominal income staying high, Our view is that the Federal Reserve may be falling behind a little bit and may have to raise rates a little bit further. And they'll likely stay there for longer until they see inflation really significantly cooling towards their long-term target. This would tend to benefit the income potential of floating rate income funds throughout this year, at least, if the economy doesn't, roll over and we start to see greater labor market softness, which could spill into credit fundamentals.
So, what are some of the key factors for investors to consider when they're researching these floating rate income funds?
I think investors should look for floating rate income funds that have a differentiated portfolio construction. So, funds that aren't completely constructed of loans. The average rating of the loan universe and the loan indices is about a single B. So even though they're, secured assets, the average rating across the universe is a single B. So there may be a significant amount of credit risk if investors are investing solely in a fund that looks like the broad loan universe or one of the indices. Investors may want to consider funds that have a higher average rating in the double Bs, say, and that diversify themselves across other floating rate and short duration asset classes, could be preferred shares, could be floating rate bonds. So just to go into each a little bit more in detail. So first lien senior secured loans could be core to the fund. Again, they're top of the capital structure and secured on the assets of the company. But it can also make sense to look for allocations to floating rate notes and bonds and preferreds. These are also asset classes that have coupons that ratchet up quarterly with changes in short-term interest rates, usually every 3 months. They can offer attractive income with the potential for some capital gain or appreciation. A fund should also consider having a little bit of short duration high yield or yield to call instruments. These are bonds that have lower yield than loans, but are also a good diversifier as they bring a lower positive correlation than loans to the other asset classes in there. And then you want to ensure that a fund has a healthy allocation to, short-term or short-duration investment-grade bonds. This is the lowest yielding portion of the portfolio, although healthy these days, where you can get like a 5% or a 6% yield for near cash positions. But you want to see a decent allocation to this alongside pure cash as it acts as a liquidity buffer. So all these holdings are floating or short duration in nature, but the asset mix as a whole is diversified, and I think that's kind of what you want to look for in a fund.
Right, everything kind of weighing out each other to sort of give the best, hopefully, potential for return overall sort of idea. That
Right.
age-old diversification. A quick note to our audience, if you'd like to learn more about some of the factors to consider when researching bond funds, watch our webinar, 5 Factors to Consider When Choosing a Bond Fund. It's available in the Learning Center on Webbroker and also on TD's YouTube page. Now, floating rate income funds can be made up of various instruments that offer different types of income. So you've gone over some of those different types of investments, but let's talk about the income. How might a fund's distribution be taxed as a result of that?
Well, like other fixed income funds and exchange traded funds or ETFs, distributions from floating rate products can be in the form of income, foreign or domestic, as well as preferred dividends and some potential for some capital gains. In general, distributions from floating rate funds and ETFs are not much different than other fixed income investments in that regard.
So majority interest, but there could be some other potential for different types of distributions for taxation as well.
Yeah.
Okay. How would you say the management fees for floating rate income funds generally compare to other fixed income products and income funds?
I would say the management fees on floating rate products do tend to be somewhat higher than traditional passive fixed income products because there is that corporate credit element to it. So there's a bit harder work to these products. This is an area of fixed income that lends itself well to active management due to the sophisticated nature of floating rate instruments themselves. The more active management that a fund has, generally, the higher the management fees.
Right. And even though knowing that they're short term, when you're investing in shorter term products, they have maturity dates coming up quicker. So I would think that would also kind of lend itself to the more active, just by nature of having shorter expirations as well, or maturities, I should say.
That's right.
Thanks for helping us understand floating rate funds, Darren. Now, let's take a moment to dive into WebWorker to find out how to research them with some of the considerations you've mentioned in mind. All right, so we're going to go ahead and click on the research button today, and under tools, we're going to click on screeners. This is a tool that we're going to be able to use to search all of the different ETFs that are available on the market. And we're going to create a custom screen of criteria that we're looking for in an ETF. So I'm going to go ahead and click on fund category. This is where we're going to choose those floating rate funds to get additional information on them. I'm also going to go ahead and choose the management expense ratio as a criteria to view. And I'm also going to choose dividends, a distribution yield, to see how much each one has as a distribution. When I come down here under fund category, I'm going to scroll through, it is alphabetical, down to floating rate loan, the option here. So here we have it. That comes up with 19 results. I'm going to deselect mutual funds, and then that way I have only 7 results available. So that's actually a pretty good number for me to take a look at. So I'm not going to actually put any further filters. I'm just going to leave those 2 criteria there, and I'm going to go ahead and view my matches. So once I get to this screen, you can see the 7 different funds that meet the criteria that I've input here today. We can see the MER information. We can also see the distribution yield all on the front page. So even though I haven't filtered by this, I can still see that information easily. I can also look at, for example, the profile for these funds, any performance information I might want to see over different periods of time, as well as risk information. When I scroll up here, if I wanted to save this screen to be able to come back and view if any funds have been added or removed from the results, because it will constantly be updated, I can go ahead and name it and click the Save Screen button. So now that saves. Next time I come back to my screeners page, I'll be able to click Floating Rate Funds and actually see these results immediately. And finally, if there was a few funds that maybe I was a bit interested in and I wanted to compare them, I'm just going to choose that left-hand box and click those boxes of the ones that I'm interested in comparing. Click the compare button, and I'll be pulled over to this comparison screen where I can see kind of that information side by side of the funds that I might be interested in. So as I scroll down, I can go ahead and kind of expand these different categories here to see different information side by side about the funds that I might be interested in. All right, Darren, we're going to have to leave it there. Any final thoughts that you'd like to share with our viewers on floating rate income funds?
Maybe just to repeat that floating rate income funds are an attractive way to diversify the fixed income portion of your portfolio by having strong income with much less interest rate risk. And just wanted to thank you for having me, Caitlin.
Thanks again for joining us, Darren. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See y'all next time.